Welcome back to Primary Source China Investment. We're happy to be here with Show You. Peng.guo and I are ready to go. And this week we're talking about two important topics. One is the fixed income market, and the second on policy is foreign direct investment. So let's kick it off with markets. And before we get into the fixed income market, I wanted to make one more point about the equity markets, because Peng.guo and I were really pounding the table trying to differentiate between the Chinese stocks onshore and the Chinese stocks in the US. We're going to put a chart up, but in the last 3 months, the outperformance for China mainland stocks over Chinese stocks listed in the US has been significant, upwards of 20%. So there was and is a fundamental shift going on between stocks traded in the US and stocks traded on the mainland. I'm sure there's going to be big changes going forward as well, with a lot of repatriation and listings. This week, we're talking fixed income. And one of the biggest changes that's happened in the fixed income market is defaults. And we've argued for a long time that defaults are good, because when you have defaults, you are having the market send investors a very clear message. Hey, no longer can you just go out and buy the highest yielding security and hope that the central government or the local government is going to bail you out. So investors are going to change their behavior. And you're also going to take out a lot of the moral hazard that's been in the asset class. So this year, we've actually seen the highest defaults on record in China. But you know, on the US side, if you look for a proxy, and the only one we really have is this CBON, that's been chugging along, giving investors an annualized return of 2.71%. So we do think that's a good asset class to be in, but there is very few products in the US for investors looking to get access to this market. So we probably have to introduce some other strategies with some other managers to access this deep, liquid, large, and moving market.
Yeah, generally speaking, China bond market is still in development. It's not like the mature, like the equity market. So generally speaking, there's still a lot of the bond available for the international investor. The total size through the Hong Kong, Shenzhen, and Shanghai connected is probably around 600 billion renminbi available for the foreign investors. So most of the investors in China, they still like hold the bond to the maturity. So it's not like the trading based bond. They don't want to sell or buy the bond. They just hold it to maturity to get the interest as well as to get the principal. Yeah, you are definitely right. So the default is good things for the market, and also is uncover the underlying risk. For example, like the Helan, they have a bond, get a big company get a default. But yeah, that's pretty famous things in the China bond market. Actually, it caused much more loss for the entire province, institute, whatever. Those they suffer the higher interest rate. They cannot get the capital from the market. I think I remember finally they resolved the issue. They pay the bond principal, and those things sounds like get resolved.
Yeah, there was another big case. It was a big case because this company Anbang, this insurance company, they bought the Waldorf Astoria. I mean, it was a very popular transaction, and what we're seeing now is that's still been working its way through. We're years on, but I just read earlier this week that Anbang's last assets that the government, Chinese government, took over are being sold for price tag is 5 billion. What they get is who knows. But at one point, this had an equity value, this company, of 300 billion. So you see that people holding this asset, whether it's the debt or the equity, they're getting pennies on the investment at the end of the day. I mean, there was fraud in Anbang, but this goes to show you that these kind of high-line, big-ticket items are working their way through the bankruptcy process, which is actually a good thing.
That's right. So if the credit risk is still no doubt, you have to do the research and to get one by one. I think in China, they also issue, there's a lot of the issuer for the China USD related bond. So totally probably around 25 or maybe 3,500 issuers. But most of them don't get the rating from the S&P. I think the 1,800 companies, they don't get the ratings from the S&P or other rating things. The rest of them, they get a rating, still pretty looks pretty good. So it makes it a little bit difficult for the investor to choose.
Yeah, that's actually a good point. The US dollar denominated debt, because that has different covenant rights, because a lot of that is issued outside of China. So it's issued in Hong Kong in US dollar.
That's right. Yeah, just to add two more points. I think firstly, like the China Treasury bond is still like the good investment vehicle. So in the security market, they have 5 years and 10 years Treasury bond ETF. Looks like the S&P, they always keep up at least for the past 2 years. So it's like the buy and hold strategy works pretty well. And secondly, for the general speaking, the China bond market, you still need to get the our strategy, like invest the opening for the uptrend.
Yeah, you know, it's interesting that there are a lot more European funds that have been launched through like a SITCAV or UCITS that invest in China fixed income. On the US side, there's very few products that are available for US investors. And it looks like probably European investors facing negative rates find the Chinese bonds more attractive than US investors who can still get positive rates. But I do think it's a big opportunity, big asset class, very few people looking at it. I know Van Eck, I keep talking about that C-bond product because it's really one of the very few products that's out there that has some track record and some AUM.
Yeah, I totally agree with you. This is a totally unique asset class. It's definitely it's different risk characteristics from the US bond. It's good for the diversification.
Yeah, so I do like fixed income. I've been talking about this for more than a decade. Sometimes somebody will listen. But with that, we're going to leave the market section here and we're going to move over to policy.
Great.
So as promised, this week we're talking foreign direct investment on policy. And after 4 years of the trade war and a significant increase in the pugilistic tone between advisors and politicians on both sides, foreign direct investment into China continues. And since this is the Olympics, I'm going to say foreign direct investment into China is faster, higher, and stronger. While foreign investment to developed countries fell 58% in 2020, I mean, obviously because of COVID, and 8% into developing countries, China experienced a 6% increase in 2020. And for 2021, government data shows that foreign direct investment into China surged, eclipsing pre-pandemic levels and up 27.1% from 2019 levels in 2021. So the old adage, follow the money, money is continuing to go into China, into new projects, into investment, and into a lot of the private entities that are going public like we've seen. So I don't think that's going to stop anytime soon. So we have to keep track of where the money's going and where the opportunity is to follow on to that.
I think right now China's policy is still the open the door, and plus they want to get a better management and control. So I see a lot of the news recently. So like the Hong Kong, Macau, and even the Highland province, they still like the step by step to implement the detail of the policy, the open the door, the figure out the details. But I think they try to get everything under management and under the control. Otherwise, this big country, they don't know what's the consequence if they move too fast. That's the general situations. So you are right. We should follow the money. It's really like the asset allocation. So asset allocation, two most important things. What's the weight for each asset class? And what's the investment assumption before you make the decision? So a lot of the trade war political related decisions really make the wrong assumptions. So I assume China is an aggressive armed country try to attack the others. That's totally a wrong assumption. I think that is a big assumption for them make the asset allocation. You will see they allocate a lot of resource to the military or political related things. They should be more focused on get more resource to get the better job. I think finally this this is asset allocation determine the return. This is how the market money realize that.
Yeah, there's a lot of companies that are going to be very smart about this too. So
that's true.
If you put tariffs on me importing from China, I may use a third country to have some part of my assembly or some part of my supply line, because companies are going to be smart. They're not going to violate any laws, but they're going to understand the laws, and it takes time for that to filter through the process. We're, like you said, we're 4 years into this trade war, and initially they were saying, well, Vietnam's going to be the new China, or Indonesia is going to be the new China, and definitely companies are reevaluating where they do business and how they do business. And we've talked about this in the past, where if you're a large enough company, you can have your own supply lines, you can own your own fields, you can own your own cotton, you can own your own channel on the mainland in China. So more and more companies are going to be doing that. And the things that they can't do in China, they simply won't. They'll just move it to another country.
That's totally right. I think it's really challenging for most of our companies, no matter big company or small company. Yeah, that's right. They face a lot of risk.
Yeah, the headline risk. The headline risk is a big problem. You remember all these brands and people protesting in the streets and taping up labels because they somehow offended China. So, that's a real risk for doing business on the ground. And if you're a big international brand, you can't afford those kind of headlines. And, there's ways to avoid that.
Yeah, that's exactly right. Even in the internet world, it's a very small things. You can be exaggerated to the big issues and cause a crisis.
Yeah, there a few vocal objectors. Yeah, you can really run afoul. So
yeah, but the people, it looks like still move forward. They have to make the decision, no matter much more complicated environment and the higher risk. Yeah, they have to do whatever they believe is right.
Yeah, that goes back to our point about the markets earlier. Where are you going to list your company? And you can make an argument that DD shouldn't be listed in the US. That doesn't make any sense. DD doesn't exist here. Baidu doesn't exist here. These are not necessarily international companies. Some of them are very localized. Pinduoduo, I don't know if they have any presence outside of China. So maybe they shouldn't be listing anywhere but China. So, this is a debate that rational people should have. It's not about a political angle. It's just, where should these companies list?
Yeah, I think the only thing is that people can think about it, whatever they suffer the loss.
Yeah. Well, we're going to leave it here this week for Show You. Our shout out to the University of Miami. Hope everybody's doing well out there. Please remember to subscribe, drop us a note, let us know if there's any topics you'd like to hear about, and we'll see you next week. Thanks.
Thank you.